that helps summarize how some of these founders should be looking at hiring CFOs, right? Because everyone knows about the degree, but the quality, I think most people are missing. Hello, everyone. Welcome to Whose Brand Is It Anyway, where we are partnered with Your Stories, Brands of New India. Welcome, Amit, Ankur, and Abhishek.
Thank you, Amit.
Adaptability as a very key factor for CFO, because you have to be continuously navigating through the changes in the organization, through the changes in the regulations. Maybe Abhishek and Amit, if you could add a couple of key qualities in a CFO, which a founder or a CFO himself should be looking up to.
Yeah, I think I would just take the play from Ankur on what F stands for and say fix it, right? I think CFO should also be a chief fix it officer. Because I think if you look at most CFOs, whether willingly, unwillingly, whether formally, informally, end up, and I don't mean this as an offense to anybody else, but end up managing HR, legal, investor relations, admin, operations, and everything else, right? So you need to have this super fix-it approach. Otherwise, it's just
I've done that, Abhishek. I've done that.
Exactly. So yeah, so that's what I would add to the list of have a fix-it approach, and fix it not in a sort of negative way, not in a fixer way.
No, we're not talking match fixing.
Yes. Yeah. I think the whole conversation is around not being that fix-it guy for sure. Amit, how about you?
I think having a spine is quite important, and linked to that, being independent. I think that is, my two thoughts on that.
I think that helps summarize how some of these founders should be looking at hiring CFOs, right? Because everyone knows about the degree, but the quality, I think most people are missing. If we were all to switch roles, let's say, Amit, you were to be a CFO, what would you have slightly differently?
I need 30 seconds to think about that, Amit, but why don't I let Abhishek and Ankur answer first?
Sure, Abhishek. Question to
that shows CFO is not an easy job to do, actually.
Yeah.
So two things, right? I mean, if one is a sort of is based on how I look at it from my lens, but one beyond that as well. One is that, I think it's very important for CFOs to use advisors in the right way, right? Don't use advisors again to cover your back. Use advisors to prop you forward, right? Many times we'll see somebody who's just coming and say, listen, just tell me, give me a report. I just want to file it. I think that you're missing the value of a good advisor. So use advisors constructively. That would be one. The other, and I'm sure Ankur is not in that boat, but I think a lot of CFOs, having grown up in an environment where finance was this function that worked 20 hours a day and treated its people ruthlessly and all of those dark ages days, continue to believe that that's the only way a successful finance org can run. So if I were to be a CFO, I think that's one thing that maybe we should change in the mindset.
Amit, back to you. If you have 30 seconds.
Yeah, no, I think the whole role, like I mentioned, of being independent. Like at times, I often get a sense that CFOs are, very influenced by what it should be rather than what it is. I think saying it as it is or saying it the way it is, I think is quite important, both to oneself, both to the management. So I think having that independent position is very important, Amit. This is what I see across the board. I think there's a lot to be done there.
Got it. And Ankur, what would you have done differently if you were a tax advisor or a person who's a partner in a diligence firm?
I think I'll take these two buckets separately. Actually, as an advisor, I would say be an advisor, not a business development officer. I think that's very important because I do encounter this a lot. Wherein it's more about commercials, and then a standard opinion or a template would come your way. And I do agree with Abhishek that as a CFO. one needs to have proactive advisory needs rather than reactive ones, actually, so that you can set up for the future in a big way. From a diligence point of view, I touched upon this. Just give the benefit of doubt to the finance teams, depending on the stage at which the investment is trying to happen or is being made. Systems and processes will never be fully mature. But of course, the reason why probably someone is raising funds is to invest in technology, systems, processes, people, and of course, growth capital to do business. And had the business been doing great, and it did not need funds to invest in these kind of areas, the diligence would not be happening in the first place, right? So yeah, that's my view as a diligence partner, that I would probably give a little bit of credit to the finance teams.
Got it. And if I could trouble you a little further, what would be your ask from investors?
Don't think about valuations, all the time, and especially exit valuations. And I'm talking about an investor once it has come onto the cap table. Because I do feel that at times promoters and internal CXOs do take wrong decisions because the investor is, probably looking at valuations and, just do the business right. I think valuations will follow automatically. So that would be my, two bits to an investor, that you have trusted the business idea, and that's the reason you have invested your millions of dollars. You've trusted the CXO team and the promoters, therefore you've invested in them. So yeah, have a review mechanism, have a monitoring mechanism, no doubt about it. But I think all of us together should just focus on the business, do the business right, and valuations will automatically come into play. Will not be a problem. And I'm a bit of a traditionalist to that extent. Cash flows are more important, operating cash flows, etc. So I'm more on that side rather than loss-making revenue multiples. So yeah, I think that's my view. Actually, valuations will follow once the business model is right and firing on all cylinders. Actually.
So Amit, from what I have seen, that the investors who have built rapport with the CFOs independently, that has gone a very long way, because the CFOs find it comfortable to actually go and discuss whatever concerns, rather than being an advisor. Investors can be an advisor of sorts, rather than someone whom you're afraid of. That how do I go and talk to the investor about this? So I think investors who have done it, and you guys do it a lot. I know you all are very proactive, but if you continue doing that with the CFO, I think that definitely goes a long way.
Nice. To be able to manage conflict, especially when it is between governance and the business, which also essentially means being strategic advisor and a conscience keeper in a certain way, right? And is there a way a CFO helps these companies to think through the business of the next stage, which is just beyond the kind of team they have built today? All of those teams are really kind of focused on building the business which they are, they have set up, but no one is thinking about the adjacencies, etc. Is that a CFO's function?
From a strategic advisory perspective, strategy is not a single-minded process. It's a collaborative process. All the functions need to come into play and then decide the way forward. And once the business strategy in place, you look at the operational strategy, and the operational strategy then feeds into the finance strategy. And that's how you then therefore realize, how much funds do you need, and how will you raise those funds, etc. As a CFO, I would say that the F stands for foresightedness, and forward thinking as well. As you move forward, and I'm talking about a bit of a scaled up organization now, not a very young startup, so to speak. I think for me personally, and I have experienced these kind of situations wherein different stakeholders have different objectives in mind and different thought processes, and you need to be the bad guy at times. You can't please everyone, and I think that's the courage you need at the end of the day to call a spade a spade. And what I believe in is, what is best for the company. Because for me, company is a legal entity. A promoter group is a different legal entity, an investor is a different legal entity. I think company, what works for the company is what you really need to stand up for and suggest and advise. Um, and I also believe that as a person who's close to the numbers, while numbers may not tell you the whole story, I think CFOs are in a good position to anticipate what is coming, probably 2 quarters down the line in terms of how the business is trending from a numbers point of view and even from an operational aspect. And, let's be very clear about this, that whatever you do in an organization, it will have a financial impact. It could be a good financial impact, it could be a bad financial impact. So a CFO today really needs to be in tune with the operational side of the business as well. And that's where you kind of, which basically lays down a platform for how do we drive the business forward. So I think it's the company first attitude, multiple stakeholder management. Uh, you cannot be the best friend all the time. Probably you could be the worst enemy most of the times for certain departments. I think you just need to have the courage and the guts to say what it is at the end of the day. And therefore it's important that there is mutual trust between all the stakeholders, and the CFO has the backing as well, of the shareholders and the promoter group per se. And then you basically given your inputs, and then the strategy gets decided in a more collaborative manner without compromising on governance and compliances, as we discussed earlier.
Amit, when you have done diligences, how have you seen this team building play out in terms of the quality of the diligence, the timing it takes, etc.? Some example over that would be helpful.
Yeah, sure. See, at an early stage, when you are probably Series A, pre-Series A, from an investor's lens, if I just wear that, I think people are generally looking to find out that the story that was sold by the founder, is it there broadly in the books? All right. I mean, may not be very accurate because it is not much vintage there already, but is it broadly there? I mean. From all respects, from the product that you're selling, the channels that you're selling, the kind of broad margins that you're making, the kind of repeatability that you're having. So I think everything is at a very broad level. So you need to have a broad level understanding about what's happening and ensure that the storyline, which was on the pitch, is not materially different from what's in the books. And when I say books, it is not just financial books, it's also operating metrics books. So, for example, you cannot see, advertising cost in isolation. You have to see with the kind of users that you're having, the kind of customers that you have added. When you get into the growth stage, from an investor standpoint, I think the product market fit is broadly ascertained. You know where you're selling, and you are needing capital for the next phase of growth or the exponential growth. At that point of time, a very nuanced understanding of what margins in the business mean. And Amit, Fireside and us, we have worked together to develop, what are gross margins, across multiple channels. If you have, a marketplace versus own website versus a third-party seller, what does margin really mean? Because sales are different, the sales numbers are different. Say, for example, you're selling it on someone like a Flipkart or an Amazon. You sell it, but your realization is net of marketing fee. So what is really your revenue? Is it the net amount? Is it the gross amount and what you sold? What about some of the schemes that they are running, Amazon Prime Day, whatever it's called? So, I mean, how do you account for all of that? And what does it mean to gross margin? Because, per channel, it is very different. So when we are at a growth stage fundraising, getting a nuanced understanding of all of this becomes very important. And hence the hat of the CFO or the finance head has to move towards ascertaining or bridging the way the business is seeing it, like in terms of what the revenue is and the way the world understands it. Because an investor would have seen 5 other companies, has probably a much broader point of view. So bridging that gap and understanding what margin really means and what CAC really means, what is brand marketing, what is performance marketing, I mean, where do you draw the differentiation? I think active conversations with your peer group becomes quite important. I mean, one person can't know everything, all right? So, I mean, it's not that I know everything. If I need to understand something specific, I'll ask my colleagues. Similarly, the network of the finance heads or the CFOs becomes quite important as to, how do you look at that? Because when you go and stand in front of an investor, getting some of the basics wrong, saying that your CM1 is X, but it is half of X. In reality, that is very embarrassing. And, that puts in doubt of the investor's mind as to, do we have the right people? Are these the right founder or the founding team that we are having? So I think the role, like in the build out on, like the finance function has to start thinking about some of these aspects when you move along.
We've been hearing a lot of negative connotation around the startups in terms of misappropriation of funds, misreporting. All of this has essentially led to a question around governance at each of these companies. And we've seen multiples of unicorns falling in the last few months. And as the funding winter continues, there'll be more to hear on this ground, right? And at the center of it all comes the CFO and the finance function, who are essentially managing governance at these organizations. Traditionally, people have been looking at the CFO and finance function more as bookkeeping and reporting as their core function, but it essentially is building the organization in a very good governance manner. And Ankur, you've been a CFO for both for some time now. How do you manage reporting and the bookkeeping function at both?
So Amit, just to take a step back, in terms of reporting, one biggest step is to basically have a common database out of which you, report. Normally in younger startups, what happens is that you may have a very basic accounting software, and then you'll have a lot of Excel sheets floating around. A syndrome which I call as Apunichi Bhagwane, wherein everyone's Excel sheet is got to them, and so you need to believe in a common database to start off. In terms of having reportings across all stakeholders within the organization, whether internal or external. It doesn't happen from day zero. Depending on the business size and the scale of operations, you'll have to take decisions in terms of how much do you invest in your accounting technologies and processes per se. Therefore, at the start of the journey, it will definitely be a bit of a unstructured way of processing information, etc. And as you move forward and scale up businesses, you'll need to have an accounting software, a team, and then eventually probably the end goal would be a proper ERP in place and creating a data lake as well. And Boat has undergone this whole journey per se. And when I entered the company, there were Excel sheets, there was a tally software, and a lot of our decision-making meetings would actually get converted into a recon meeting wherein different functions would be having their own databases and kind of trying to do a reconciliation between ourselves. Today, we have reached a stage, wherein we have a daily MIS with a lot of key metrics inbuilt, whether it's P&L items or balance sheet items. We have almost daily collection reports, daily debt limits coming out of the system, bank limit trackers, weekly inventory, debtors aging reports, monthly MIS packs, and during this whole journey, when you have private equity investors such as Fireside Ventures investing into you, the whole system also gets more robust in terms of monthly investor packs getting created with a lot of key metrics inbuilt into them. So that's the finance and accounting piece. From a legal and compliance perspective, we have legal and agreement trackers in place. We have compliance calendars in place, which of course have different frequencies attached to it. I think the bottom line remains that at what stage of your journey you are as a startup, and how much and when do you invest in proper systems and processes and accounting softwares, which will lead to uniform reporting, both financial and non-financial metrics, and having a lot of value add discussions amongst all the stakeholders. And like I said, You don't want to have recon meetings sitting with the promoters and the founders actually, or with the CXOs for that matter. You need to have data which is objectively present so that it leads to efficient decision making eventually.
Great, Ankur. I think those are really valuable insights. In fact, as investors, we are always keen to look at some of these matrices and always pushing the portfolio companies to build that system and processes as they keep growing. In fact, we've seen where the companies have failed to do so. We have seen valuations taking a hit. When there's no reporting structure in place, there's always a misreported number. May not be always a red flag kind of a number, but there's always a 10% plus, minus, etc., which keeps happening in all of these situations, right? Which essentially impacts the valuation of these companies. But Amit, you also deal with reporting when you do diligences in these companies. How does that impact your due diligence? Some examples of what has gone right, what has gone wrong.
I think it's a very important question in the current environment, Amit. This whole topic about governance and the role of the CFO. And to add on to what Ankur said, he emphasized a lot about the data management across the stage of the company. I think the role of the CFO and the finance function also changes as the company evolves. I mean, if you're a Series A or a pre-Series A company, one might think that, you don't require a very senior CFO because the company is young. But, on the other hand, you do need an experienced person to get the nuts and bolts right. I mean, you can't, leave it to chance. And, we have done a lot of deals together, Amit, and we have seen that in a Series A or pre-Series A companies, things can go terribly wrong.
Right.
If you don't have the finance function sorted. So, you might want to look at, say a virtual CFO or a part-time CFO, someone who's really experienced and who can get all the nuts and bolts right. And as the company evolves, you might want to have someone like a head of finance, and then someone probably specializing in tax or, say for secretarial matters, separately. And as the company becomes as big as, say, boat, for instance, you have to have a full-time CFO with, heads of tax, heads of secretarial, heads of legal, so that the company and the role of the CFO also changes as the company evolves. The second one is that, a lot of points were mentioned about recon. I always believe that, the book closure process or the statutory audit process has to be as uneventful as possible, especially in high growth startups in the current environment, because you are going on submitting so many MISs to investors, to prospective investors, to other stakeholders. And at the end of it, when some accounts come at the board meeting, it gives different set of numbers altogether. And now that is very eventful, then people have to explain why this happened. So even though the business or the management sees the accounts or numbers in a particular way, it's very important to reconcile it to how it will look when the books are audited at the end of the year. So for example, the commonly used topics are on revenue recognition, that how management sees revenue, how the auditors see revenue. So when you say that your MISs will give you a revenue of 100, the auditor says, no, it should be 60. But nobody had a clue that the auditor is going to say it's going to be 60. So, even though you take a stand, it's important to reconcile it with what's going to come out at the end. So having proactive discussions with your statutory auditors as to this is the way you're looking at it, what do you think about it? I think that's very good, practice. The other common area, which I always come across is how do you treat advertising cost or intangibles? It's very common in D2C companies that you invest a lot of dollars or rupees in advertising. Do you want to charge it off of the P&L? Do you want to take it to the future years? Whatever be the business rationale, I think it's important to discuss with the auditor and provide a recon as you move along, so that the year-end process is very uneventful and nobody gets too excited that our audit is complete.
Yeah, thanks, Amit. I think just to add to what you were saying, I think in one of the portfolio companies, we saw one case, there was a payment which was made to a wrong vendor. Now, essentially, if there was a right finance head with adequate segregation of duties, I think this could have easily been avoided. And a recovery to a wrong vendor at a startup stage, where you're dealing with large organizations, it is almost impossible, right? You're not able to even get the next PO from these guys. If you have to get back money from someone, it is going to be impossible. Abhishek, you also come across a lot of this reporting, which then results into your tax filing when you're helping these companies in their tax filing, GST filing, all of these compliances. How have you seen this being a challenge or a good thing when you have come across in the startup environment?
Sure, Amit. I'll answer that, but I just wanted to chime in with a couple of points on what Ankur and Amit said. This whole MIS piece. I think what, in my opinion, startups should focus on is if they are measuring, let's say, revenues in a particular way. What often happens is that whether it's the most basic ERP or the most complex ERP, in their ERP, they're measuring revenue in a completely different way, right? So I think it's very important that capture your data internally as close to possible as how you see it as a business. That will, to a large extent, eliminate the need for someone to pull out the data from ERP and then move it, as Ankur said, to Excel sheets and then to have reconciliations. You will have some, you can't totally avoid it, but try and see whether it's an expense item, whether it's a revenue head, whether you need it by geography, to whatever extent it is possible. And of course, it depends on how sophisticated your systems are. But try and match the data capturing internally versus how you want to report it to your board and to your management. The other point was, on this whole auditor debate. I think that's I totally agree with Amit. The audit closure in startups is becoming a larger and larger event, just because there is such a big disconnect in terms of, as he explained, what the management expects something to be and what it turns out to be. I think there again, while at an early stage, a startup may not be under Ind AS and may still be following the IGAP, I think what would be very helpful for CFOs or whoever is a finance head to think of accounting 101, right? And that is really, in a sense, what Ind AS is. It's all principle based rather than prescription based. And I think if people really think that what are the basic fundamental, is this going to be revenue or this is not going to be revenue? Will this be deferred or will this be amortized? If CFOs take things from that lens, I think it will make this whole disconnect and hence this event a much smaller one. Coming back, Amit, to your question on sort of compliance. Again, I think there are a few thoughts I have. One is that the biggest trap to stay away from, we're just an early stage startup, this can wait. Nothing can wait today. I think whether it's day 1 or day 100 or whatever it is or whatever your revenues are, compliance has to be center stage. And I think that's where the finance function needs to have spine. I know we'll probably talk about that a little later, but it's very easy for the businesses, the founders to push and say, this compliance can wait. I just want this deal done. I just want to go and sign this contract. While it's never an either or situation, I think it's about standing up and making sure that the compliance also gets done. The other thing that we've seen is, people looking at compliance as a tick in the box, right? We've seen situations where the data in the GST return will be completely different from the data, let's say, in your TDS return. And I think the reality today is the government triangulates data zillion times better than the best tech startup or the best even large cap company in India today, right? And I think people need to remember that. And therefore, I think what would be very useful for a CFO is to say, okay, I've filed my TDS return, I've filed my GST return, but whether internally or through external help, can I just do some sanity checks and make sure that in addition to, meeting due dates and things like that, my data in these returns seems somewhat similar. And I think the big example I'll give you is that we've seen so many instances where the GST filings done by companies is contrary to their whole FDI business model, right? Because the person handling the GST compliance has no idea, no visibility on what the whole business model of the company is constructed as from a foreign direct investment perspective. So I think that's, to me, the biggest gap that we see, where everyone looks at compliance as a tick in the box. No one takes a sort of holistic view. No one tries to sort of triangulate things against each other, and therefore get comfortable that, yes, in addition to meeting my due dates and deadlines, I'm also comfortable that the data that's gone out to the government is something that I can defend and back up.
Thanks, Abhishek. I think that's very meaningful what you said. In fact, some of these compliance checks and reviews is what we also recommend to most of our portfolio companies. In fact, you helped us in a lot of those occasions. I think, Abhishek, when we are around compliance, what is also very important in an Indian environment, which is regulatorily so challenging, is for these startup founders as well as the finance heads to understand what are some of the big challenges for startup as far as regulations are concerned.
Sure. So, uh, it's very common in today's market that a lot of people who operate marketplaces work with independent sellers, right? Now, I think the question really is that are those sellers then truly being independent in how they operate? There can be some oversight by the main marketplace company on the operations of those sellers, but we end up in situations where either the marketplace entity is pretty much even generating the invoices for those sellers, which is clearly then in violation of the rules, or could go the other extreme where they have no visibility on what kind of positions and HSN classifications and rate of tax they are charging. So I think it's important for whoever's running the function to understand why certain things have been put in place. Why are there different sellers? Why are there different marketplace entities? Or if you have a certain obligation under the retail policy, etc., what are those obligations? And similarly, to have then a mechanism, to track that. The other thing I wanted to highlight as an example, Amit, is on valuation, right? I think we are all aware as to how complex it has become because you have a FEMA valuation, you have a Companies Act valuation, and you have an income tax valuation. And oftentimes these sort of go in, three different directions, but you have to find that sweet spot where they all converge. I think finding that sweet spot is challenging in its own way, but that's something that one can find. But what we repeatedly see is, somebody just then saying, listen, just get a valuation report done to come up at this value, right? And no one pays any attention to what kind of assumptions are being taken, what kind of projections are being given to the valuer. Because with due respect to any valuer, the output is only as good as the input they get from the management. And we've actually seen reports which may be 3 months apart from each other, right? Where let's say the outcomes are more or less the same, but the projections are completely different because one set of valuation was handled by one team who just pulled out and rustled up whatever projections they could. And the second report was done by another team who did the same. So I think my whole point on many of these examples is that it's impossible to have the same person do everything. But whenever the head of finance or the CFO is looking at compliance or looking at any of these regulatory requirements, there needs to be some system through which they can sort of keep cross-verifying what's going on.
We have Abhishek solving these complex areas. In your diligences, you would have found a lot of day-to-day operational compliance issues.
Yeah.
Can you throw some light on that? And we can possibly look at Ankur, how he solves for it in both on a day-to-day basis.
Yeah. No, I think Abhishek has highlighted some very good points, like as to what are applicable to startups and, early stage high growth ones. I just want to underline some of the concerns that we see very often, in diligences, typically, especially in D2C, kind of startup environment, it is very common that, you are doing contract manufacturing or, you're buying products that you sell from a contract manufacturer. And in that also, you may be buying the raw material, giving it to the contract manufacturer, and they process it and they assemble it and give it back to you, or you're buying it outright. There are GST implications for each of this movement of goods. How do you treat it from a GST standpoint, one, and how do you treat it in the financial books? I have seen some very interesting ways. It's not that obvious because sometimes people take record sales for whatever you're selling it to your contract manufacturer, for further processing, and then show purchases. Once you get them back, and your sales and purchases is inflated. So it is not just a GST standpoint issue, but it is also an accounting point issue. So like a trigger is that if you're doing contract manufacturing, whether the right taxes are there, the right accounting is there. I think that's one big topic which we see all the time. Second one would be, the other trigger, like to think about more deeply, would be on, like on the whole employment and the HR standpoint. Take, for example, you are using, contract workforce. you are having gig workers, like for say to meet demand of a peak season. So, what are you doing with the contractors? Are you taking them to a third party contractor? Are you taking them, directly in your company? So then there are different regulatory requirements, tax requirements as to how do you treat them. I think so that is one, a good area to, focus on. The other one would be more on, how do you treat some of the accumulation of GST? Like at times, there are two ways to look at it. From a financial modeling standpoint, is it your working capital that never gets freed? Because if you're continuously accumulating those credits, then you have a cash lockup. So when you are forecasting what is your cash requirement in the business, just by saying receivables, payable, and inventory won't be sufficient. You have to see what is your GST lockup as well that is sitting somewhere else in the balance sheet. So I think some of these points, have a more regulatory financial planning as well as accounting implications.
Yeah. No, I agree. I think as these companies also keep growing and becoming larger and expanding new product lines, go across geographies, you don't have control over everything which happens in another geography. You don't understand that complication. I think a finance head will have to really keep his head tight on that aspect when that expansion is happening. People are always thinking only commercial. Ankur, but you've been at the other end of this, right? You've been solving for some of these things. How are you set up as a system to solve for this? How do you plan this way ahead in time so that at this scale now, especially because you're under attention all the time, right? Unlike a very early startup.
So actually, I've been listening to Abhishek and Amit, quite pertinent points. I think one thing is very critical to understand that at what stage of a company, you're looking at certain points which are getting discussed. We keep using the word startup, but actually beyond a very simple turnover, a legal entity ceases to be called, a startup. So actually, you're looking at a mature company or a fast-growing company than just a startup. What we're looking at is at what stage is the company, irrespective of the stage. Given the current market environment, compliances are a no compromise area. That's the bottom line, whether it's a crore of a turnover or 1,000 crore turnover. And compliances, whether it's tax, legal, secretarial, the biggest diligence findings or negative diligence findings which you come across are actually in the taxation areas, or on the lack of secretarial filings, or the legal diligence area. These are the big ones, and therefore you cannot afford to play catch up. You can afford to play catch up on quality of talent, on an accounting system, or lack of processes, documented processes, but you can never play catch up on compliances. And as you grow, I think the promoter and the investors as well need to understand that compliance or allocating capital to compliances is actually not a cost. It's an investment. While we keep saying that, oh, how did this happen? This was a negative thing which happened during diligence or even post-investment. But when you push for investments into compliance, I have observed that there is a lot of pushback saying, oh, it's a cost center. Why do we need to do that? And, let's allocate more capital or more budgets to certain other functions, which will be more revenue generating. So I think that's the change of mindset, which also needs to creep in from across all the multiple stakeholders in a company. So therefore, you need to invest both in people and systems at the same time as you grow up. At both, basically, it's all about regularly reviewing the tax filing, the returns. I think a fundamental thing which we believe in is now that this is the right stage, or in the last 12 to 15 months, is the stage when you get specialists into play. After a certain stage of the company, you cannot really rely upon generalists in the finance and accounts departments. You really need to have specialists. You need to have tax specialists on board. You need to have, like the virtual CFO concept. I think after a certain stage, you can't even outsource your secretarial work. Of course, you'll always need secretarial firms or tax firms to help you, but you need to have specialists on role. And the most important thing for us is that people understand the business and the operations, from a legal perspective, because otherwise you'll have a very siloed way of thinking, wherein you just talk legal and compliance and you don't understand the business perspective of how to enable business at the end of the day. So yeah, I mean, I think at the end of the day, it's not a cost, it's an investment, and this kind of a mindset, has to come through all the founders and all the shareholders as well, who are investing in startups today. We are an omni-channel company. We have e-commerce, we have offline, and then we have our own D2C website. And we treat the channels as companies in themselves. So that's the structure we are now getting into at our end, wherein you cannot say it's a sales channel. You have to treat the channel as an organization, as a company in itself, wherein you have to be very careful about compliance and governance standards, both accounting, taxation, and legal and secretarial as well.
Abhishek, what would be your advice to companies who are now at a much smaller scale, right? So how do you advise these founders to build systems around compliance?
So firstly, I think to go into, if you're coming in as a finance head or a CFO, whatever you're called, to go in with this assumption that the founders are just business focused and, techies or scientists or innovators and don't understand numbers, I think is the starting problem at some level. They will pick up numbers on investments and valuations and dilutions, etc., even before you can finish your sentence. And I guess that's part of why they're so innovative and so bright. So I think it's important to keep that in perspective. The other thing, as Ankur rightly said, as you're building the blocks, there are innumerable times when you need to take judgment calls. I mean, with the largest of companies and the best of resources and the best of advisors, there's still ambiguity in life. And this is not an India problem, right? I mean, regulations, tax laws, business scenarios will always remain ambiguous. And particularly when you are at an early stage of growth, the ambiguity will sometimes be much higher, or the requirement to take a judgment call will be much higher. So I actually think that at the stage you're talking about, let's say 0 to 50, 50 to 100, 150, the person at the helm of the finance function, the way I sort of, when we work with them, say, listen, if somebody woke you up in the middle of the night and asked you this, what would you answer them? That should be your test of the judgment call that you should take. So don't try and sort of come up with this very convoluted explanation and modeling and say, therefore, I will do this, because you will know it. Nobody else in the team will know it. And again, like I said, if somebody shakes you and wakes you up in the middle of the night, you will also forget your own story. So don't build and take judgment calls based on stories that are so hard to understand, so complex that even you might forget them at some point. That's, I think, a very critical aspect for any growth stage company. The other thing that we keep hearing, he or she is my finance head or he or she is my CFO, but they're not really CFO material. And again, I think a bit of advice here maybe to founders that's a little bit of a disservice because I think what is a CFO also differs from what the stage of the company is. Right? If you are a 50 crore company and you're comparing your finance head, whatever you call that person, to the CFO of Infosys, who you may have met in a cocktail the night before, definitely there are going to be differences, right? Not because of inherent sort of lack of capabilities or competencies in your person, but just because of what that person in Infosys is managing versus and what their focus areas are versus what your finance person's focus areas are. So I think that's again a trap that we've seen a lot of early stage companies fall into, where the founders actually don't trust sufficiently their finance heads and almost treat them as the proverbial bean counters. And that's where things start to fall apart, because on paper there is a CFO, but in reality, things are not really being empowered. And the last quick point I'll make, Amit, is, a lot of times companies and CFOs to that extent start believing that if my investor is not asking me for something, this is not important, right? And I know as Fireside, you all are sort of very founder first. You're always there to help founders, etc. But there are a lot of investors who are just financial investors, and it's not by accident, but by design. They do not ask for more than what the company is sort of giving them as MIS. But that should never be taken as a sign that therefore this is not important, and therefore if they're not asking me for my GST compliance, it's not important and things like that. So I think that's another sort of very soft trap that a lot of companies fall into.
No, that's great. I think we as investors, at least at Fireside, what we have done with these companies is I think we have sort of tied them up with certain compliance tools which help them track their compliance needs and monitor at a management level how this compliance has been. We get compliance review done in some of these companies. I think some of these, if implemented at early stages, can really help them through that, navigate that phase till they build this large organization where then there are experts who can take care of this, right? How does this finance head or this, the promoter build this finance org? And Ankur, you're a CFO and you've done this for some time now. How has this org played out from the early stages of the company, and how is it now?
So Amit, I'll actually bucket this conversation basis turnovers or even pre Series A or post Series A, whichever alphabet we will refer to. And I'm looking at with this whole Shark Tank seasons also into play. I'm just looking at a very simple startup, which is trying to do business. I think initially, till the time you do not attain confidence in your revenue model and business model, I think it's important to keep your fixed costs down. At the same point in time, therefore, you really need to figure out what to outsource and what to have in-house. To extend what Abhishek said just now, I think it's fair to say that initially you can have a great finance controller and not a strategic CFO straight away. And a finance controller, in the sense, what I mean is basically a person who's taking care of the accounting piece in a very honest and fair manner, and the taxation bit, because you are still yet to figure out whether your business idea will become successful or not. So you can have a outsourced secretarial firm, because eventually you are a company, you have to file your do your ROC filings. You can have a small time tax consultant who's helping you with the taxation, but your Spock would be the finance controller, who's an in-house resource on the roles of the company. Now, as you grow forward, I think you'll have to come into play wherein you'll have to think about your accounting systems. And I'm looking at, say, a 50 to 100 crores, wherein you're probably also looking at a possible fundraise, for the first time or maybe a second or a third time. And that's when you start building out teams, basis your structure of business, so that you are diligence ready also. So from that perspective, a little bit of shift from the outsourced activities to in-house will come into play. Therefore, the structure will evolve as the business moves forward, in my view, and and this will be a journey, from an accounting department to a full-fledged strategic finance, corporate finance, treasury management. All those functions will come into play. With specialists, because when you start off, you'll probably have a single person doing, okay, I'll talk to the banker also for limits, working capital limits, and the same person would actually be probably doing some invoice booking also. The same person probably, or another person could be just coordinating with the GST consultant trying to file monthly returns, which is fine, because you need to keep your fixed costs low at the beginning. So as your business grows, your structure will evolve, and therefore, you'll have to invest in people and processes. And from an accountant, you've got to be more of a CFO. So I would not probably say that from day zero you really need to have a CFO in place. And Abhishek did say that and rightly so, that the founders are pretty well versed in terms of basic numbers. So actually, one of the founders can actually develop as a strategic CFO at the beginning, because Once you scale up and a CFO comes in, it's very important that even the founder's bandwidth gets loosened up to do more strategic thinking in terms of creating value for the business and not just act as a finance or some other functional head, so to speak.
Great. I think all of us touched upon the day-to-day needs, right? But people who come to you with complex transaction support. And as these companies grow into this 500 crore, even 200 crore mark, these complexities require different kind of expertise to understand. Operational CFO may not always be able to solve this problem. How have you seen companies build this expert finance function?
So, Amit, I don't think this is something that gets built by just fitting somebody into a role or anything else, right? I think it's part of the evolution that Ankur spoke of. As the company grows, the maturity of the finance function grows, the maturity of the finance leader grows. And as part of that maturity, when they are faced with complex problems, they're able to sort of cut through the chase, as we say, right? So I think it's very important here to build the tone that when you are trying to solve for a complex situation or a complex outcome, there will be judgment calls to be taken. Make sure the CFO has all the apparatus internally and externally to take them, externally through all the advice that they need, internally through having sounding boards, could be other functional colleagues, could be with the founders themselves, and of course with the investors. And then to have an institution that backs you up should things not really go as per plan.
I think the whole diligence process, the turnaround times, the mindsets, are actually a function of, once again, at what stage are you raising funds, the ticket size, and therefore the turnaround times will get impacted because, when a 200 crore company is trying to raise funds for the first time, the quality of team will definitely be more, I would say, not very sophisticated. And therefore the investment banker plays a huge role in setting expectations, when an IM has been designed and he or she goes out in the market trying to target future prospective private equity investors. So, vis-a-vis when you already have a private equity investor on board and the second round happens, the expectations are different and the maturity of the finance team is different. Therefore, the expectations of turnaround times and the sophistication of data and the diligence process per se, is far higher than what it was earlier during the first round.
Yeah, I think I completely agree with you, and we have seen this across our portfolio as well. When we come in, typically the diligences take 2.5 months time. But as the company is progressing, there's someone inward managing this process now as a finance head. We've seen this time reducing significantly, and the expectations of each of those stage investors are also very similar. That's great. I think the last couple of minutes really summarize how we all can collaborate together and work better for the betterment of the company and all the stakeholders of these companies. These are really valuable inputs. And thanks, Abhishek, Amit, and Ankur, taking time out of your busy schedules to help some of these entrepreneurs as well as finance heads think through their own finance journey in their organization. And I would also like to thank Your Stories, Brands of New India, for partnering us to bring in WBIA into action, and Bound India for making this whole session happen. Thank you, everyone.
Thank you, Amit. Thank you for having us.
Thank you.
Thanks, Ankur and Amit.
Thank you.
Thank you, everyone.